This is the Creating Wealth Through Self-Storage show by Mark Helm. Nothing Mark shares with you guarantees your success in the self-storage business. This is for informational purposes only. There are no calls to action, and nothing said or implied is a call for investment money into self-storage or any other asset class. You are responsible for your success in the self-storage business or any endeavor in life. Enjoy the show, and here is Mark Helm.
Some dots have been connected for me recently about self-storage trade areas. And oddly enough, it comes from the Big Short in the 2008 recession. Let's talk about tariffs, trade areas, and self-storage today. My name's Mark Helm, and I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Quickstart Academy, which houses the training that I offer the small investor who wants to get in the self-storage business or who wants to grow their self-storage business. You can find out more about it at creatingwealththroughselfstorage.com. And I'm a CCIM, which is a designation inside the commercial real estate industry. And recently, our state chapter had Michael Litt scheduled to come and talk to us, and people really from all over from as far away as Chicago, Columbus, drove into Louisville to hear this speaker. And when I found that out, I did a little bit of research on him. Now, if you saw the movie The Big Short, which came out in 2015, you saw an abbreviated version of what Michael Litt and his hedge fund did during the Great Recession when they shorted the credit market. So after I did my research on what Michael Litt did in 2006 through 2010, I was very interested to hear what he had to say about what's going on today in today's economy. And I took some of his information and I translated it on to my self-storage business. I was also curious about investments, where he's hedging his funds today in this current economy. So I want to share some of that in this and the next episode. But before we do that, let's go back to 2006 through 2010 or so and talk about the Big Short. So Litt was an asset allocation manager for Front Point Financial Strategies Fund. And I think it was 2006, might have been 2005, but in 2006, he wrote a research paper entitled The Great Compression. And in that paper, what he saw was that the fundamentals in the credit market had become disconnected from pricing due to the leverage that was embedded in those structured credit products. He was one of the first, if not the first, to see the looming crisis that was ahead of us. And I think that paper came out in early 2006. Might have even been 2005. I don't know if you remember 2006, but it was a boom economy. It had been booming and going for quite a while. We were borrowing money in the low 3s, 4%, 4.25% was high interest rate at the time. And I can remember there even being talk from some people during that time that recessions could be a thing of the past because the Fed has gotten so good at monetary policy. So what happened is in 2006, Litt and his group decided to fund another hedge fund. This was called the Front Point Opportunity Fund, with between $75 and $125 million, with the sole purpose of shorting the equity, credit, currency, and commodities market. Many thought he was crazy in 2006. And I'm sure most of you know, but when you short something, what you say is, I'm betting, I'm investing that the price is going to go down. So if you short something at 100 and the price goes down to 20, that's your spread, that's your profit. So they were betting that the credit market was going to blow up. The US dollar was going to go down. But you probably know the rest of the story. Litt and his group made over 500% return during the Great Recession. I sure didn't make 500% on my investments during that time period. Did you? So why did I tell you that story? Well, the takeaway is follow the money, not the news, not the politicians, not the politics. Follow the money. Money flows where returns are. The trick is find the right person. So when Michael Litt was going to talk about where he's putting his money in today's economy, I became very interested after I studied what he did during the Great Recession. So in today's episode, we're going to talk about one of my big takeaways for self-storage with the tariffs that are in place and more coming in place. Next week, we'll talk about the positive and things to watch out for impact on storage and the economy in general. The OBBBA, One Big Beautiful Bill Act that was recently passed. So first of all, to get a general overview of what we're going to talk about, I think it's important to see where Litt sees at this particular moment in time, like this week, where the economy is and where he's starting from, what his general overview is. And here's his general overview. The economy and jobs are weakening slightly, and inflation's now beginning to show up in the price data. He does project a 25% basis point interest rate reduction this year. The OBBBA has significant economic stimulus component over the next 4 years, especially for those of us that own commercial real estate. However, that bill is going to add $3 to $3.5 trillion in national debt through 2035. We'll talk about that next week, show you what the administration thinks it's going to add in terms of debt and what other think tanks say that it's going to add in debt. The tariffs are going to really function as a consumption tax. We'll dive into that today and how that's affecting or could affect self-storage. And this is going to increase the cost of goods between $200 and $300 billion per year while these tariffs, or at least what they're talking about as the tariffs, are going to be in place. And uncertainty tends to delay economic decisions. And I can confirm this firsthand, raising funds in today's market. In fact, it's not in the written episode, but I just watched a video on the private placement market. And in 2024, we don't have the data yet for 2025. I'm sure it's going to be the same. But in 2024, there was $1.2 trillion less investment flowing in to the private placement market than there was in 2023. When there's uncertainty and many investors sit on the sideline. And today, let's focus on tariffs. And as we talk about tariffs, there's some in place and more are said to be put in place. Canada, for example, has a 35% tariff, but it's not really 35 because there's a lot of goods and items that are excluded from the tariff or are tariffed at a lower rate. So it's really hard for me to figure that out. Mexico is tariffed at a different rate than Canada's tariffed. Brazil's tariffed at a different rate because the administration is mad at them about something. India is tariffed at a 50% rate because the administration's mad at them about something. And to the rest of the world, this is really unsettling. To the rest of the world, it looks like U.S. economic policy has no rhyme or reason. 50% in one place, 30% in another, 10% in one place, 20% in another. And the administration recently fired the labor statistics chief because it didn't like the numbers. So this is very unsettling on an international level. Now, a valid question might be, why should I care what foreign countries think of us? Well, here's why. At any given moment, as much as 2/3 of the U.S. long-term debt is purchased by foreign investors, both private and governmental. And in the past, the U.S. long-term debt has been very attractive to foreign investment because of the perceived safety, security, liquidity, and the overall confidence in the U.S. economic policy and the U.S. economy. Now that's rapidly decaying. So what will happen is there's going to be less buyers for our long-term debt, which is going up in the next 10 years. So that means there's going to be less buyers, and most likely higher yields are going to be demanded to buy that debt, which translates to more interest to the U.S. on the long-term debt. Now, it doesn't matter if it's true or not about foreign investors' perception of the U.S. Perception is reality. Money flows where returns are the highest or returns are the safest. U.S. long-term debt has always been safe, and now it's rapidly turning into not that. But let's talk about tariffs and storage in particular right now. So what I found very helpful was LIT broke U.S. household incomes down in increments of 10%, 1 being on the lowest, 10 being on the highest, and has created, and this is the work he does. He doesn't do this for the public. He doesn't do this to go, talk to politicians. He does this within his fund so that they know where they're going to be putting their investment dollars and what they're hedging against. So I found it very interesting to look at the chart, and I'll show you how I'm translating this onto self-storage. Now, this chart's going to talk about the impact of tariffs and the impact of the new tax bill that was passed and how it's going to affect each of the income brackets in groups of 10%. Let's take a look. I tend to put way more credence into this type of research than I do anything coming out of anybody from Washington I've heard in the last 20, 30 years. Let's take a look at the research. So first of all, the blue is the impact on household resources, and the red is the tax bill impact on household resources. And the first chart we're looking at, and we're just going to glance at this, deals with the impact as a percentage of their household income. And the second chart deals with the numbers, the dollars they're estimating of the impact on household income. Now, again, 1 being the lowest, 10 being the highest. The tariffs are going to really just function more like a tax than anything else because the additional costs are being passed through. There's no government tax man standing at the docks collecting money from China or Brazil or Canada. What happens is who picks the goods up pays the tariffs, and then who buys the goods from the person who picks the goods up pays. That's passed through to them all the way down to the consumer. So it functions like a consumer tax. And here's how it's going to impact everybody, no matter what your tax bracket is. Now, it's very doubtful whether many of the people in the first 10 or 20% of the lowest income group really are storage renters. But 3 through 5, 3 through 6 are. Now, here's my experience when I've been in trade areas that are on the lower side of the scale. Money's tighter, there's less discretionary spending, so every dollar counts. Therefore, the average length of stay is shorter. And the shorter the stay, the less the average value of a customer is. The higher the unit churn, and the higher the marketing costs, because they got to spend marketing costs to release that unit. Now, if you're in a lease-up situation, this has a drastic impact on you because if you've got a 30-month lease-up period to get to 85%, and your average length of stay is 10 to 12 months, you're renting that same unit 2 or 3 times on your way to lease up. And what that does is it increases your marketing costs, and it stretches out the lease-up period. The nightmare scenario is your interest-only period runs out. You're not at stabilization. You're not even profitable yet because you're releasing the same units over and over again. And I've been there, and it's not fun. Therefore, more than ever, we're looking not just being, I used to talk about whatever the median income, the average income is in a city, that we're on the upper end of that rather than the lower end. I'm now really focused on the upper third of the income strata that is divided, like in the chart you're looking at in 10. I'm looking at 65 and up on income, median income in a trade area. That's what we're going to be focused on. Now you might say, how do you find that out? Offering memorandums only tell you part of the story if you're looking at the demographics in there. And then you can Google or look in a county or a zip code or a market or a city and get it, but that's not very exact. Let me show you a tool we're using and how we're looking at it today. Now, this happens to be a subscription service that we have, and they have a feature I've just recently started using, and it's Radius Plus. I'll show you what we're using. Now, other subscription services may or may not have this. I don't know. I'm not an affiliate of Radius Plus. I hope they're okay with me sharing this. But everyone in our inner circle is using this tool, and let me show you how we're using it today. Now we're going to look at some real deals that we're looking at. As soon as I started doing my research on Lit, what I did was I ran back and I pulled this tool up, and the first thing I looked at was a boat and RV project. Now I'd done the preliminary research before, and I'd known that we were kind of in upper, above the median income and above the average income in that market area, but I wanted to see in that trade area where we were exactly. So here's a location for a large $15 million boat and RV project that's under construction, where ground is getting ready for groundbreaking. Now what I like about this tool, they call it the Low Poverty Index. I would call it something else. I don't know why it's just not called Wealth Index. But what I like about it is it's broken up into the stratas, from 0% to 100%. And so I'm looking, and it's real simple for a guy like me who's pretty simple. You can see the colors, and I'm looking in the upper third or, maybe a little lower, but not much. And the majority of a 5-mile trade area, now my trade area might even be larger, I don't know, for the boat and RV part of it, but a lot of our trade area is well above 65 to 70%. Next, here's an expansion we're doing. Got a 30,000 square foot expansion. Now that yellow triangle within the circle is small, and what it is, there's just no houses there. That's a business and industrial area, and surrounding it is where all the people within the trade area live. And within a 4-mile trade area, this is clearly on the upper end of the income strata. Next, we're writing an LOI in the next day or so on a project, and this is in a much smaller market. Let's take a look. So even in small markets, there's only 60,000 square feet in a 4-mile radius of this site. Look at that square foot per capita. And this is an opportunity to do an expansion. And again, the majority of our trade area is in the upper, 20% of the income stratus here. Simple, great tool, makes it easy for somebody like me who's not that smart to be able to see where the income bracket is of the people living in my trade area. And today we're focused again 65% and up. It's never been more important, in my opinion, to make sure that your trade area is located within an area that has high rents, because higher per square foot rents, because we're almost always doing some construction expansion, and construction costs are high, interest costs are high, and today we're really ratcheting up the income levels in the trade area as the tariffs take hold. Next week, we'll go over the tax bill and how that could really impact us and what some strategies are for the next 12 months or so you can use. And the tax bill will have some positive impacts on us as well as some negative ones. But we'll focus on that next week. But I wanted to share with you how we're relating to income in a trade area and the actual tools we're using in real time right now and what we're looking at and what it looks like. If you're interested in finding out about Radius Plus, just Google Radius Plus, reach out to Alex there. You'll be able to find him on their website. He's been a big help to us in our inner circle, and I'm sure he'd love to talk to you. So thanks a lot. My name's Mark Helm. I hope this has been helpful to you. My goal here is to learn out loud, share with you what I'm focused on and what we have our attention on as we go through this industry and this industry evolves. My goal here is not to change anyone's mind or change anyone's political view. Well, maybe a little. Thank you very much. I look forward to being with you next week.